Welcome back, everyone. Today's video is going to be a bit different. It's going to look back at the evolution of the bull thesis for uranium and how different elements have kind of not worked out or been delayed, and just go into a little bit of how things in uranium kind of are slightly different than some other commodities. So to start, I'm going to take you way back, almost a decade now. After Fukushima, Japanese nuclear reactors came offline. And the first bull thesis after that, I guess you could call it, was that the reactors would come back. And while the premise of this is sound, eventually, with reactors, the demand grows, then eventually more uranium is going to be needed. The problem is, at the time, even if you had added back all the Japanese reactors, there still would have been a surplus. And so that in and of itself, even if all the Japanese reactors had come back, well, in a moment's notice, in let's call it 2014, it wouldn't really have meant that more uranium was needed imminently. Then the bull thesis kind of evolved into, well, the price is too low. And when you go to most other commodities, the price goes too low, and supply comes offline, and the price immediately reacts, starts going in the other direction. Even a small cut in some commodities can mean a massive price change. But in uranium, there was a large cut, or before that even, people were saying, the price is too low and the price must go up or the lights go out. And while that's true, it's not exactly imminent. And the problem is there was contracts, and the way uranium production works is on long-term contracts. So the contracts protected production from having to go offline. And so they kept producing. Then we had the supply cut. McArthur River, the largest high-grade uranium mine in Canada, very large mine, very relevant to global supply, came offline. Market shifted from surplus to deficit around that time, and that had to be it, right? Well, not exactly. Because then, remember how the delay in the cut came from the producers being protected by contracts? Well, that meant that we had a bit of an inventory build. And the thing is, when the inventory built and then the supply cut, even when it switched from surplus to deficit, there was still inventories, and with the marginal price being set by the marginal buyer, the price didn't react immediately. And if you look back at the first year after Cameco shut down this massive mine, well, there was a surplus, but Cameco's inventory dropped by, what was it, 14 million pounds, I think? And that's significant for a producer to cut down their inventory by that much. And this is relevant because if you're in the market, you don't see a price change, you see a mine that comes offline, and you're like, oh, well, I guess there's still plenty of uranium, right? So now you got to a point where the market was surviving in a deficit by eating through inventory. And first it did it slowly and kind of around the edges ways, and then it eventually should trickle back to the producer, or sorry, the consumers of the uranium, who will draw down their inventories. There's inventories everywhere, but there always is in the sector. Now, the point is, or the bull case here, was that contracts will be needed to produce enough uranium, and that will require uranium to be at a higher price for the contracts to work for the producers. Now, the delay here, and the reason why this took, well, can take years, is that there's a carry trade. And for those of you that don't know what the carry trade is, I suggest reading about it more than what I'm going to say here. But basically, traders would buy up material and contract it out midterm. So they'd buy it on the spot, or they'd source it from offtakes or whatever, but they'd have it, and then they'd slowly, or they'd contract out the material for carry fee. And so that filled the short-term demand, and which meant that the price didn't have to move while the above ground inventory is being eaten away. Now, I just want to make an added point here, because remember, assuming this is the numbers here backing these assumptions are more or less correct, the market needs to figure out when it is going to finish drawing down inventories approximately between a year and a half and 3 years before it actually can. So if it thought that 2020's level of inventories would be about right, it would probably need to figure that out in 2018. And since obviously that happened, and the price obviously reacted 2 years ago, enough to bring on supply, we're here now, and because we are where we are now, we will be where we will be in a year and a half to 2 years. And that's just the speed that this market works if you want to get optimistic. Now, I do also want to make another point, and that is term contracts in uranium are vital. Mines don't get built based on spot price. That said, investments and psychology and decisions around where to put money for the distant future, ironically, seems to happen more so along the spot price. So there's a bit of a bifurcated decision-making process that goes along with uranium. Now back to the bull case history. Let's backtrack to when Cameco shut down McArthur River. Remember, this is a big mine, but they didn't just cancel half of their contracts and just say, you know what, price is too low, too bad. What they did instead was they decided that since the industry operates on long-term contracts, and since contracts often have an element of spot price built into the pricing that they receive, what was in their best interest was to get under the spot market. And by this, I mean what they had to do was they put themselves in a position where instead of instead of producing more and just having other people dump on the spot market and crush the price, what they were going to do was going to take some of the demand that was already priced into the market in terms of long-term contracts and chew through the spot material that was being produced elsewhere and sold cheaply to supply into those contracts. So what they did is they took this material that they were getting from the spot market and they sourced it into their contracts instead of what they would have been producing from McArthur River. Now, this makes the long-term contracts mix with the fundamental demand from the market. And so eventually, in theory, they would be pushing at the price, they would be pushing upwards. And if the market were in deficit, eventually it would start rolling upwards because they wouldn't be able to find enough material based on the current market dynamics. And if you're thinking about how this would work, imagine pushing something that's really heavy and has wheels, let's say. You could be pushing hard initially, and it could just be getting nowhere. But eventually, once you kind of break the stalemate and things starts rolling, well, then it becomes more difficult to stop because it's just your force is just suddenly, all of a sudden, really working, and it's a completely different story. So by now, we've come a long way. If the bulls are right, there's not only a deficit, not only less inventory than there ever, well, not ever, but less inventory than there was since the early 2000s above ground, but also you have the second largest producer buying, and that's Cameco. Now, Cameco also recently shut down not only the second biggest or the biggest mine, but the new biggest mine, and that's Cigar Lake, in addition to McArthur River. Both of these two massive mines are shut down. So now they have to find more material from the spot market. But that's not all, because now Kazatomprom, the world's largest producer of uranium, in addition to all of their joint ventures, are also facing a disruption. So the interesting thing here is there's still a delay. Everything in uranium is delayed. Everything in uranium is delayed. I can't honestly think of a single thing in uranium that hasn't been delayed. But the point is, from the time that the disruption was known about, first you had 3 months approximately before that disruption is actually, the production from the disruption is actually reduced. And then after the 3 months, 4 months, whatever you want to call it, something like that, you then have the ability for the producer to work down some of their excess inventory. But the thing is, once that happens, they too would have to potentially have to enter the spot market along with Cameco to find material to buy. And remember, at this point, there's a lot of disruptions and there's a lot of uranium that has to be found in the spot market. And it's unclear if it will be able to be found without potentially the demand actually moving prices. And we'll have to see. But that could be an issue even before long-term demand comes back to the market. And again, I want to make this point very clearly. Both Kazatomprom and Cameco that are now, let's call it under the price, and may have to be buying material and may be pushing the price up, both of them are pretty much fine with that because Kazatomprom, most of their contracts are spot reference. So basically they buy for 30, sell for 30, or buy for 40, sell for 40. Doesn't make huge difference. It's not a negative impact because they're paying more there. Obviously they'd like to produce for whatever and sell for 40, but they're fine with it. And Cameco, well, they have all of those pounds for McArthur River that they can contract out at higher prices. So again, they're fine with it. So in conclusion, this market is so slow. And what that means often is that prior bull and bear cases are still relevant, just not for a time after they're seen or should be enacted in the market. And the point I wanted to make is I believe that if you treat this market like it's oil or like it's copper, I think it's a recipe for disaster because this market works differently and inventories contracts are big deals. They may seem like just unnecessary complications, but I really believe that if you treat this like any other commodity, there's probably going to be some point where you realize that you're in trouble. And that's not to say you shouldn't figure it out, invest, learn, whatever. Just be careful if you're going to treat this like it's any other market because there's many things about it, not just a few of the things I've hinted at in this video, but a number of things that make it act differently. Now, that could be a very good thing if you can maybe figure out how to understand and predict what the market is. Now, that said, when it comes to predicting this market, I think that if anyone claims with certainty that they can narrow something down to something very close to accurate, I'd be very concerned. I've spoken with a few people and myself where I'm just like, if I can hit this within 6 months of what I think is going to happen, that's basically, I'd be thrilled with that, because there's a lot of things that make it less efficient. And often those things, that type of thing, can lead to massive volatility, emotions taking over. And these two kind of go together, mistakes and blind luck. So there's a few things out there that I've seen, and just be very cautious for instances in the past where someone has made some money in uranium. Now, obviously, there are some people that are very brilliant. There are some people that that I would really listen to, but there's also some people who have had varying degrees of success that, if you look through the decisions that were made, you might come to a wow, this person lucked out conclusion. That being said, don't, you know, don't take my word for it. Look through decisions made in the context of what was happening then when you're analyzing past decisions. Now, no, obviously, no one knows everything. No one's right all the time, but this market works differently, and just knowing that this market works differently is not enough, because there's many people that understand that the market works differently but don't understand how. Anyway, everyone, thank you for watching. I hope you enjoyed or found something interesting at the very least. And remember, while I hope you learn from different things that I say, nothing is investment advice. It's just as one tool for your research. And with that, I wish you all the best, and we'll catch you next time.